Hi everyone. Welcome back to Positioned.app. Before we begin, make sure to like, follow, and subscribe, and join us for free at Positioned.app for more professional insights on swing trading, technical analysis, and market strategies designed to help you trade with greater confidence and discipline. In our previous video, we explored the core principles of mean reversion, how prices stretch away from their average and tend to snap back over time. Today, we're applying that exact framework to SPY from March 3rd to March 31st, 2025, using Bollinger Bands 20-period SMA with two standard deviations, walking through where price stretched, where probability shifted, and how disciplined traders could have managed risk within a structured mean reversion approach. This is where theory meets execution. Before we dive into the chart, let's quickly recap. Mean reversion starts with a simple observation. Price oscillates around a moving average. When it moves too far away, beyond normal statistical boundaries, the probability of a snapback increases. But not every deviation reverts. The volatility environment ultimately decides. So we look for three things. First, price pushing beyond two standard deviations. Second, signs of exhaustion, momentum slowing or reversal structure forming. And third, a clear target, the middle band, which represents the mean, with risk clearly defined. Now let's see how that played out in the chart. SPY begins March near the upper band, around the 590 level. Then selling pressure accelerates. Price pierces the lower Bollinger Band multiple times, and volatility expands as the bands widen. This tells us price is becoming statistically stretched to the downside. But remember, not every lower band break is a buy signal. During volatility expansion, markets can continue trending. What we're waiting for is exhaustion. However, around March 10th to 13th, SPY becomes statistically stretched, deeply extended below the lower band near the 548 to 550 area. At the same time, downside momentum begins to slow. Now the setup aligns with our checklist. Price is beyond two standard deviations. Momentum shows signs of exhaustion. The target is the 20-day moving average. And risk can be defined just below the recent swing low. Over the next few sessions, price reverts back toward the middle band, a textbook snapback. As we move into mid-March, the environment changes. Volatility contracts. The bands narrow. Price begins moving sideways. This is exactly what we discussed. Mean reversion performs best during compression phases. Between March 14th and 21st, we see repeated touches of the upper band near 570 to 575, followed by pullbacks to the mean. Then the lower band touches near 555 to 560, followed by bounces back to the middle band. This is structured oscillation. Entry at extremes. Exit at the mean. Controlled risk. There's no breakout attempt, just rhythm. In contracting volatility environments like this, position sizing can be more confident, because volatility is contracting rather than expanding. Around March 24th, conditions shift again. SPY pushes toward the upper band, but fails to break higher. Lower highs begin forming, and volatility expands to the downside. On March 28th, price breaks strongly below the lower band. This is critical. When price rides the band during expanding volatility, that is not mean reversion. That signals potential trend continuation rather than temporary deviation. This is where disciplined traders step aside. Trying to buy every lower band touch during expansion typically leads to losses. The market is transitioning from range to directional pressure. An aggressive entry here would disregard the need to confirm the market environment first. After the sharp decline toward 548 to 550, we finally see long lower wicks, price reclaiming back inside the band, and momentum slowing again. Now the framework aligns once more. Extreme deviation. Stabilization. Clear mean target. SPY begins reverting back toward the 20-day average, around 555 to 560 into month end. Within 1 month, we've seen the full cycle. Stretch. Snapback. Compression. Expansion. And then another exhaustion bounce. To summarize SPY price's movements, March 3rd to 13th, downtrend, extreme deviation, bounce. March 14th to 21st, range bound, ideal mean reversion. March 24th to 28th, breakdown and volatility expansion. March 31st, exhaustion and snapback. SPY transitioned from expansion to compression and back to expansion again. Opportunities emerged, but only for those who adjusted to the evolving volatility environment. Let's reconnect this to the trading plan. First, scan for two standard deviation moves. Second, confirm exhaustion. Third, enter with a target at the mean. Fourth, define your stop, often 5 to 10% below entry depending on volatility and time frame. Finally, exit within your predetermined time frame. March demonstrated both profitable reversion setups and clear defined no-trade environments, reinforcing the importance of respecting volatility shifts. The biggest mistake would have been assuming every lower band touch must bounce. Discipline separates probability from hope. This SPY example reinforces our core message. Mean reversion is not prediction. It is probability management within defined conditions. When markets overreact, opportunity emerges. When volatility expands into trend, discipline protects capital. Understanding the environment is more important than any single indicator. Next time you're analyzing a chart, compare price action to its moving average, and look for confirmation from momentum or volume indicators, such as RSI, stochastic oscillators, MACD divergence, or volume behavior. Ask yourself, is price stretched beyond 2 standard deviations? Is momentum showing signs of exhaustion? Is volatility contracting or expanding? Challenge yourself to identify these setups in real time, not just in hindsight. Don't be discouraged by early mistakes. Every chart you study strengthens your pattern recognition and execution discipline. Trading skill is built through structure, repetition, and controlled risk. Share your insights in the comments. If you found this helpful, like and subscribe for more trading education content. Also sign up for Positioned.app for real-time swing trading signals. Let's make smart trading decisions together. Thank you for watching. Until next time, happy trading!